Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix, Steele, and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. So head over to youtube.com, search Bloomberg Podcast now, and that's where you'll find us. Geopolitical news coming out of Ukraine and Russia. Russia is willing to discuss a temporary truce in Ukraine, provided there is progress toward a final peace settlement. That's according to people familiar with the matter in Moscow. Let's get more reporting on that. Ros Mathieson joins us, Bloomberg News Director for Europe, the Middle East, and Africa. Ros, what do you make of this news coming from Mr. Putin? How significant could it be?
Well, it is significant. As you were saying, we've had the exclusive information that Vladimir Putin has indicated he's open to a short-term truce on Ukraine with conditions, and that this offer has been, in fact, conveyed to the Americans. It was conveyed at that meeting that was held in Saudi Arabia last month, and it comes before there's talks between the US and Ukraine, also in Saudi Arabia, early next week, and the possibility after that of a direct meeting perhaps between the presidents of the US and Russia. So what this really indicates is that Vladimir Putin is amenable, at least, to looking at a ceasefire in Ukraine. He just wants to understand how that fits into the broader trajectory towards a longer-term peace in Ukraine. And so he's got some conditions there that we've reported in our story just out a short time ago.
So we just spoke quite a bit about potential peace in Ukraine with no mention of Zelensky. So where is Zelensky in Europe and on this potential ceasefire?
Well, that's right. Again, this may serve to feed concerns that Ukraine is really a recipient in this case, in terms of being told this is what we're all talking about when it comes to their own country. And that's been a concern for weeks for Ukraine, but also for many a leader in Europe. And the hope is that by having, Zelensky express regret for how things went down in that recent Oval Office meeting with Donald Trump, that they can reset a bit, get towards that minerals deal that was supposed to be signed and wasn't signed, and then get Ukraine back in the room in the conversation about a ceasefire. Because again, the concern is, does this get driven very much by the US and Russia? And then Ukraine essentially gets told what the parameters of this are. And that's got to be still a concern for Ukraine at this point.
All right, Ros, thank you so much. We appreciate that. Ros Mathieson, Bloomberg News Director for Europe, the Middle East, and Africa, on President Putin said to be ready to agree to a Ukraine truce with conditions. We'll have further reporting on that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
These markets are up, they're down, and that's just in the morning and trading. We got yields coming in here. The 10-year Treasury, 4.25%. Yields are moving as well. So again, another volatile day for a volatile week as the market tries to discount a lot of policy coming out of Washington, D.C. Emily Roland, she gets paid to do this stuff. Co-Chief Investment Strategist at John Hancock Investment Management up there in Boston. Emily, how do you kind of put all these cross currents? How do you keep them straight and try to keep the eye on the prize, which is, longer term performance for your funds?
Yeah, it's tough right now. The macro is really in the driver's seat, and investors are largely ignoring the fundamental backdrop. Politics in particular, of course, driving a lot of the cross-asset action, so it can be tough. Right now, admittedly, the U.S. is experiencing a bit of a soft patch, economically speaking. The data haven't been great, but there have been some bright spots. Certainly, ISM services on Wednesday coming in at 53.5, and the U.S. jobs report this morning coming in at 151,000, very modest revisions to the last couple of months. So for now, the labor market is actually on pretty solid footing. Of course, the DOGE announcements around government layoffs haven't been factored into the data, so we might need to sort of enjoy it while we can. But the U.S. labor market continues to be the bright spot here as it relates to the economy.
What's interesting, though, is today we had the Treasury Secretary speaking on CNBC saying that there's going to be a detox period for the market, that the economy has become hooked, and we just got addicted to government spending, and now we're going to detox it. if that indeed is the plan, right, wean spending off of government spending, put it on the private sector, lower rates in order to incentivize spending, and then lower taxes as the kicker, do you need to transition for that?
Yeah, I mean, it's a pretty remarkable shift from the relentless amount of fiscal spending that we've done over the past couple of years. So, Alex, the starting point is really high. If you look at the jobs that have been added, Nancy Lazar's got some great statistics on this from Piper Sandler. About 95% of the jobs that have been added over the past year have been in government and healthcare. That's a massive amount. So we're starting from a really tricky point here as we impose some of this fiscal austerity. And you're seeing it happen really across markets. Meanwhile, overseas, you've actually got policymakers in areas like Germany that are proposing spending measures there. So we're seeing a bit of an opposite day play out here in terms of less fiscal support in the U.S. and more fiscal support in areas that have previously been very austere.
So, Emily, we had Gina Martin Adams from Bloomberg Intelligence on earlier talking about she's seeing some rotation from the U.S. equity markets into Europe for just those reasons, concerns about growth here, and maybe some better expectations for Europe. How are you guys thinking about allocation geographically?
I mean, it is just remarkable to see some of the moves that we've seen and the huge capital shift to areas overseas, international markets just on a tear this year. The European, the euro surging. So it's quite notable. We always, though, look for a fundamental catalyst. Right now, I think a lot of these moves are based on political developments that we talked about. They're based on momentum, short covering potentially, a kind of sentiment and optimism driving those moves. And when we look underneath the surface, we're really not finding a meaningful shift in terms of the earnings narrative. Analysts are penciling in about 12% earnings growth in the United States this year. It's a little bit off 15% that was penciled in a couple of months ago, but still pretty darn good. Meanwhile, you look overseas at IFA and emerging market estimates, they're not that great. They're in the low single digits. So we're just not finding that catalyst from a fundamental standpoint. European markets right now, we're pricing in just exceptional economic growth and exceptional earnings growth. And we just don't see things looking that exceptional.
So does that mean that the amount of spending that Germany is going to do, you don't buy it, or you just don't see it to be immediate?
I think some of both. I mean, we always come into this with a little bit of skepticism, and the actual size of the spending is still much less than what we spend here in the United States, especially from a defense perspective. So we're going to need to see how this plays out. We're going to need to see if Germany can come out of the slump that it's been in for some time based on these measures once they get put into place. But for now, we've got to focus on the fundamental trends. And they're better here in the United States, especially for U.S. value stocks, where we're seeing meaningful acceleration in terms of earnings estimates into 2025.
All right. So back here in the U.S. here, talk to us about opportunities in fixed income. I'm hearing more and more people say, boy, with this uncertainty out there, I'm just going to go clip a coupon, and I'll come back in 6 or 12 months.
Yeah, we really like the income that's available in high quality bonds right now, with the aggregate bond index yielding about 4.5%. It's really competitive versus equities. We're sitting at elevated valuations around 21.5 times forward earnings on the equity market. I mean, still not terrible, but not great. And meanwhile, you're getting a discount on bonds. We saw a pretty meaningful backup this week as bonds traded in sympathy with German bunds, which just saw about a 40 basis point increase over the course of the week, which is the biggest in over 20 years. But we would look at those backups as opportunities to lean in. If the economic data continue to disappoint at the margin, if this soft patch continues, we think U.S. bonds here get a bid. They can benefit. And listen, the dividend yield on the S&P 500 is like 1.3% right now. So equity income ain't what it used to be as it relates to finding income in the equity market. We prefer to do that in bonds. We think there's more relative value there as we head into the remainder of the year.
All right, Emily, great to catch up. Thank you so much. Emily Roland, Co-Chief Investment Strategist for John Hancock Investment Management.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Also in studio on Fridays. Boy, it's not We're seeing more and more people in on Fridays, I guess is what I'm trying to say.
What?
You
are seeding this? This is huge for Paul, by the way.
I think it's happening.
Okay.
I don't know.
Okay.
Catherine Doherty joins us, finance reporter, Bloomberg News, joins us again here in studio. In a story that, quite frankly, concerns me, NASDAQ joins exchanges seeking to offer round-the-clock trading. Tell us about this.
Paul, I don't know if you need to be concerned right away.
Okay.
They made this announcement about their intention to extend their trading hours. So
I intend to go on vacation at some point.
Exactly. Okay. But let's take a step back to say that these plans are far out. So NASDAQ gave some indication that they don't expect this to actually start happening until the second half of 2026. So this is not even a 2025 story, but specifically for the exchanges. And the reason being, the numbers that we're seeing right now, anything that is trading actively on any of the public exchanges, that data is all going to one feed, and that feed cannot accommodate overnight trading right now. So in order for this to actually move forward in a meaningful way, and for NASDAQ, NYSE, SIBO, any of the exchanges to offer overnight trading, that data feed needs to be updated, and they need to work together to make sure that it can all.
All right, this is the way it works. When I was on the trading desk, you get in at 7. That's the bed. It was a little early, particularly if you're out late the night before with clients. Trading starts at 9:30. Bell goes off at 4 o'clock. 4:15, you're at Farrell's across the street.
Sure.
Having a couple cocktails. That's the way it's supposed to be.
Right.
None of this stay late and trade late kind of thing.
Right. So, okay, great point. So why do they want to even do this?
So they are saying that the demand for U.S. stocks that they see, particularly abroad, is enough to start offering this to their clients. But when you talk about the actual demand and who it is that's actually behind these trades, a lot of it is coming from retail investors. It's not the big institutional block trades that are coming through at 4 a.m, particularly for the instance that you're describing, Paul, of showing up, you're at your desk. Those parameters are likely to stay in place, but you want to have some flexibility if you have an office that's in Asia. I think what's going to happen is that the staffing is what's going to change. So you might not have the trader in New York that has to stay much past 4 o'clock like they normally do, but you might have to hire another trader in Asia. Maybe you're hiring a team in Europe to accommodate for the earlier hours in the U.S. There's ways to do this that doesn't mean those of us in the U.S. and particularly in New York are going to have to stay late or wake up earlier.
Wow. Okay, that's fine. But the funds, they don't do this trading though, right? It's like big funds like the CTAs, the vol-controlled funds, like they wouldn't trade overnight.
Right now, they can't, but
would they? Because usually they just trade in the cash market.
That is the big question. So
that would be something.
Once NASDAQ and NYSE and all them start to offer this, the question is who's going to take the advantage per se? Who's going to actually be the ones that are trading overnight?
And who does it first? Because when one person starts, and they all have to go, right?
Right. And really, what is there's a lot of speculation that the retail trades that are being made, there's not enough liquidity, so therefore the experience, the price that they're actually getting, the execution quality suffers because of that. But if there's more trading that happens, that could start to improve the quality, and thus there might be even more trading that starts to happen because of that.
Would this mean no closing bell at 4 o'clock?
That's something that the industry needs to decide on.
Right.
Because think about it.
Ding, 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 ding,
think about it. If there's no
dinging?
opening or closing bell, you need to actually decide at what point are we into the next trading
How
day.
does Bitcoin do it? I'm
Tiny
just asking
brain
rhetorically.
blown.
I don't know. I don't know how Bitcoin does
It's a different market structure, but it's funny. I saw a lot of posts on X today from the crypto community saying, "Oh, nice of you to join us, equity exchanges. We've been doing this, and come along. The water is warm."
I don't know.
That's
All right,
pretty amazing.
We'll see. It's progress. You can't stand in the way of progress, Alex.
Says the guy who doesn't have to do it anymore. In the same way. All right. Thanks so much, Catherine. Really appreciate it. Catherine Doherty, Bloomberg finance reporter, joining us. The NASDAQ joining an offer to go around the clock.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix Steele, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Ololu Aganga joins us. She is the U.S. Chief Investment Officer for Mercer, joining us via Zoom. Ololu, John and I were just talking about this. Boy, things have changed in the last couple of months here in terms of the outlook here. When you see $1 trillion market cap loss for a company like NVIDIA, boy, that gets your attention, doesn't it? How do you feel about these markets?
So the concentration in the equity markets has been a problem for some time, and problem meaning like it's hard to be able to distinguish yourself when you have a benchmark that is moving in that positive direction. We're seeing a swing in the opposite way, right? But the concentration is still the same. So when you have a key handful of stocks that are driving markets in either direction, it does create challenges. Now, with that said, we're in a situation now where we're kind of back to pre-election type of markets. But with all of the macroeconomic data that's coming out, we're looking at it, as you all mentioned on your show, economic data was okay this morning. So no surprises from an employment standpoint, but it hasn't factored in the cuts yet.
So how do you manage the volatility at the end of the day? Is it defensive? Is it offense? Is it cash? Is it treasuries?
So a lot of flow, and it all depends on the client portfolio objective. So for some of the longer dated clients, the pension clients, they're heavier in fixed income anyway. They've always, historically been. So this is a boon for them. We're seeing 4 or 5 basis points decline in yields this week. Last week was a pretty dramatic move, especially in longer dated bonds. And if you think of the liabilities the pension clients have, that is something to be mindful of. Then if you're talking about the shorter dated aspect, so the yields on 2-year money market, like those have come down. So if you're trying to earn returns, that may not necessarily be, the best with regards to that point. But there is a more defensive environment, yes, that has been created and some uncertainty around it. The facts are tariffs, no matter which way you look at them, are higher input costs. And input costs for corporations affect them in one of two ways. It's either lower margins, so you have to either absorb that. So we'll see that play out in the next few earnings report, maybe, or if you pass it on to consumers, then you run the risk of potentially lower sales. So the drawback and the drawdowns that we're seeing in the market is almost, what is it? Buy the rumor, sell the news. So it's proactively moving in that direction because of those two potential things that can happen as a result of higher input costs for corporations. But we have to see it in the earnings.
Ololu, since the market started moving higher there in mid-2022, a lot of folks have said, boy, we just haven't seen that 10, 12, 15% pullback in a market that oftentimes can be healthy for a longer-term bull market. Do you think we're approaching that now, or is it maybe even something more problematic?
So, yes, we haven't seen a pretty big drawdown in quite some time. But if you were to analyze post-financial crisis, even when we have, and if you, of course, we all remember the COVID period where we saw even bigger drawdowns, the rebound on that was actually fairly dramatic and fairly swift. So the challenge with that, really focusing on the drawdowns is because you can't time the markets. We can have it could happen Monday, Tuesday, right? We could very much see the potential of that occurring, but positive news that could occur could cause it to move very, very swiftly. So for us, as you are thinking of investing and not trading, right, because there is day trading and you have to be able to move with the volatility cycle if you're day trading or moving that quickly. But if you are investing, the goal is to be able to cut through the noise and go through more sustained themes. As we just talked about, something like corporate earnings. How will that play out if we see higher input costs? So that is what we're doing a lot of work around to make sure that we can look past today, tomorrow, and go through a quarter, 2 quarters, 3 quarters type of thing.
Where does this leave then corporate credit?
So
she laughs at me as I ask. That doesn't bode well.
It's corporate credit, just like equities, right? So two sides of the same coin for the corporate entity is not immune. So we've seen a tightening of corporate credit just recently, but now as we're going through a period, now we're starting to see some widening that's occurring in certain pockets with rates where they are, and we're just seeing the volatility. It is difficult with regards to issuance. Now, when rates were much higher, it's expensive for corporations to be able to fund. So if you're issuing new debts, you're issuing them at higher and higher levels. If we see a situation whereby the environment becomes a lower rate environment from here, then for corporations and corporate credit, it's a tighter environment. And that's good to some degree, but it means you're not necessarily earning the yield and call it investment grade credit. So there's the potential for clients moving out the risk spectrum, but right now, not really. Right now, it's sort of wait, but lots of volatility in corporate credit, the similar thing that we're seeing even in treasuries.
All right, Ololu, thank you so much for joining us. Ololu Aganga, U.S. Chief Investment Officer at Mercer.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.